You know, those financial reports, they can be pretty dense, just walls of numbers sometimes.
Absolutely. Eyes glaze over pretty quickly.
Right. But what if you could kind of cut through all that? Get to the real story, the important stuff behind the figures.
That's exactly what we're aiming for today.
So in this deep dive, we're tackling the latest numbers from IndusInd Bank Limited, their Q1 FY26 results for the quarter ending June 30th, 2025. They just came out July 28th.
Yeah, hot off the press, we've got the investor presentation, the board meeting outcomes, the press release, the whole package.
Our mission. To turn all that detail into something clear, something engaging for you, we'll hit the profits, the digital side, even, some of the tricky bits they're dealing with.
And what's really interesting is seeing how these numbers link up, how they connect to the bank's big strategy, the wider economy. It's not just about the figures themselves.
We want you to get those aha moments, right, where it all clicks.
Exactly. A shortcut to really being in the know.
Okay, let's get into it. The big headline seems to be IndusInd is back in the black for Q1 FY26. Net profit of 604 crores.
That's the story they're leading with, yeah. A robust recovery, they call it, from the challenges last quarter.
A recovery is good, obviously,
Yeah.
but how robust is it really? We need some context here.
Absolutely. So 604 crores, definitely a turnaround from the loss they reported in Q4 FY25. That's positive.
But I sense a but coming.
Well, compared to the same quarter last year, Q1 FY25, it's actually down, significantly down, 72% lower than the 2,171 crores they made back then.
Wow, okay. That's a big difference year on year.
It is. And just for context, IndusInd positions itself as India's fifth largest private bank. Huge distribution network, over 7,200 points across the country.
42 million customers, roughly.
Around that, yeah. They follow a universal banking approach, so they're into a bit of everything. That scale is important to remember.
Got it. So quarter-on-quarter recovery, yes. Annual picture less rosy. What about the top line? Revenue.
Total income, yeah. Came in at 6,797 crores. And you see a similar pattern here.
Down year on year, up quarter-on-quarter.
Exactly. Down 13% compared to last year's Q1, but impressively up 81% from the previous quarter, Q4.
That 81% QOQ jump is massive. What drove that?
Well, let's look at the components. Net interest income, or NII, that's their core lending profit, was 4,640 crores.
Okay. Also down year on year.
Down 14% YoY, yeah. But up 52% quarter-on-quarter. Still a strong QQ recovery there.
And other income. Fees, treasury stuff.
That's where you see a really dramatic QOQ surge, 2,157 crores. That's up 204% from the previous quarter.
200%. Wow. Although still down 12% year on year.
Right. And all this feeds into the operating profit, which was 2,568 crores. But that one was actually down 35% year on year. So a mixed bag when you look closely.
It really is. So the return to profit is the headline, like you said, especially after last quarter's loss.
Definitely the immediate good news.
But looking past that single profit number, how strong is the bank underneath? You mentioned ratios earlier. What groundwork allowed this rebound, and what's the underlying health like?
That's the crucial question, isn't it? Profit is one thing, resilience is another. And they did highlight some key ratios.
Like the net interest margin, NIM.
Exactly. NIM came in at 3.46%. Now, that's actually up 121 basis points from the previous quarter.
Okay, 1.21 percentage points higher QOQ. That's a significant improvement in their core lending margin, right?
It is. It suggests they're managing their lending and borrowing costs maybe a bit more effectively in Q1. Although it's worth noting it's still down 79 basis points compared to a year ago.
Right. What else? Provisions. Capital.
Their provision coverage ratio, or PCR, held steady at 70%. That's pretty robust, covering potential loan losses.
And capital. Always critical for a bank.
Very healthy. Their capital adequacy ratio, CRAR, was 16.63%, and that's excluding the Q1 profits. Tier 1 CRAR was 15.48%, well above regulatory minimum.
So they have a good cushion.
They do, and liquidity looks strong, too. Their liquidity coverage ratio, LCR, averaged 141% for the quarter. Again, comfortably above what's required.
So these underlying ratios, they paint a picture of stability, even if the profit swings are large.
I think that's fair to say. These ratios, capital, liquidity, provisioning, they act like shock absorbers. They give the bank room to navigate bumps in the road, like maybe a volatile quarter or rising NPAs, which we should probably talk about. This resilience is arguably more important for the long haul than one quarter's profit number.
Okay, good point. So let's pivot to the balance sheet then.
Yeah.
Loans, deposits, the core stuff. What's happening there?
Well, interestingly, we saw a bit of a pullback in Q1. Both loans and deposits dipped slightly.
Oh, how much?
Loans or advances ended the quarter at 3,033,694 crores. That's down 4% year-on-year and down 3% from the previous quarter.
And deposits.
Deposits were 3,097,144 crores, flat year-on-year, but down 3% quarter-on-quarter as well.
So a slight contraction? Is that a strategic choice, maybe being more cautious?
Mm-hmm.
Or is it tougher competition?
That's the million-dollar question, isn't it? It could be caution in a tricky market, or maybe just a tougher environment for gathering deposits and finding lending opportunities right now. We need to watch if this trend continues.
What about the type of deposits? CASA, the cheap current and savings accounts?
Yeah, CASA took a bit of a hit. It came in at 1,025,006 crores. That's about 31.5% of their total deposits.
Which sounds okay, but how does that compare?
It's down 14% year-on-year and 7% quarter-on-quarter. That's quite a drop for those valuable low-cost funds.
Ouch. Did term deposits make up for it?
Term deposits actually grew 8% year-on-year to 2,072,138 crores, but they were still down slightly, like 1% compared to the previous quarter. So shift towards more expensive term deposits, maybe.
Okay, and the loan book itself, how's that split?
They've kept the mix fairly steady. It's still 60% consumer banking and 40% corporate banking.
Within consumer, what are the big chunks?
Vehicle finance is the largest at 29% of the total loan book. Then you have non-vehicle finance at 23% and microloans at 8%.
Microloans. IndusInd is a big player there, right? Through BFIL.
They are. Second largest microfinance lender in India, they say, serving 12 million customers, mostly rural.
And they mentioned something about focusing on older relationships.
Yeah, they highlighted that. 81% of Q1 microloan disbursements went to centers operating for over 2 years and 79% to customers who've been with them for over a year. They call it a focus on vintage.
Trying to reduce risk by lending to more established borrowers, perhaps?
That seems to be the strategy, focusing on clients they know better. However, despite that focus, the overall microloan book shrank. It was down 23% year-on-year and 8% quarter-on-quarter.
Huh. So even focusing on vintage didn't stop the book from contracting. Interesting.
It is. It suggests maybe challenges in that segment overall, or perhaps they're deliberately tightening criteria significantly.
Okay, this brings us to asset quality. We have this positive profit story quarter on quarter, but you mentioned rising NPAs, non-performing assets.
Right. This is where it gets a bit more complex. The numbers did tick up. Gross NPAs, or GNPA, rose to 3.64% of total loans as of June 30th. That's up from 3.13% at the end of the previous quarter.
And net NPAs, after provisions.
Net NPAs also increased to 1.12% from 0.95% quarter-on-quarter. So the trend is upwards in Q1.
Is this just a lag from past problems catching up, or are new loans going bad?
It's likely a bit of both. Some stress seems concentrated in specific consumer segments.
Right.
Well, the microloans we just discussed showed a very high GNPA percentage, 16.39%.
16%. Wow, that's high.
It is. And two-wheeler loans were also elevated at 10.21% GNPA. So specific pockets of stress within the consumer book seem to be driving part of the increase.
You also mentioned past issues.
Exactly. And the bank has been quite open about this, which is important. They previously disclosed finding discrepancies in the financial year that ended March 31st, 2025. Remember that?
Vaguely. What were they related to?
There were issues with derivative trades, income recognition in the MFI portfolio, the microfinance part, and some manual accounting entries. Altogether, it was over 3,400 crores involved in those discrepancies.
Right. So how does that connect to the current NPAs? And what are they doing about it?
Well, addressing those past issues properly impacts current provisioning and potentially recognition of bad loans. The crucial part is their response. The board set up a specific project management group. Their job is to strengthen systems, tighten controls, basically prevent repeats.
And accountability.
They mentioned initiating disciplinary action against the personnel involved, so they're signaling transparency and corrective action.
Okay. So while the rising NPAs are a concern, the fact they're acknowledging past issues and taking steps, that's a positive signal in terms of governance.
I think so. It's often called cleaning house. It can be painful short-term as problems surface, but it's vital for long-term trust and stability. That commitment to fixing things might actually be a more important takeaway than the NPA number itself this quarter.
Makes sense. Okay, let's shift gears a bit. Beyond the core financials and asset quality, Their digital push seems like a huge part of their story now.
Oh, absolutely. They are really hammering home their digital 2.0 strategy. The numbers are quite striking.
Like the overall digital transaction mix.
Yeah, 93%. That's incredibly high. It shows how much activity has moved online or through apps.
And their main app, Indie, for consumers. How's that doing?
Really strong traction reported for Q1. Monthly active users, MAU, apparently up 2.6 times just quarter on quarter.
Wow. Any specific examples?
They gave a few. Fixed deposit bookings via the app up 220% QoQ. Savings accounts opened via the app up 292%. Mutual fund bookings, get this, up 600% QoQ.
600%. That's massive growth.
It is. And even personal loans or lines of credit dispersed through the app were up 37% QoQ. Plus, the app won a Payment Pioneer Award. So definite momentum there.
And they have one for businesses too, right? Indie for business.
Yes, targeting MSMEs, micro, small, and medium enterprises. That's relatively new, less than 6 months old, I think.
How's it catching on?
Pretty well, it seems. They reported 100,000 MSMEs registered already, and nearly 30% are monthly transacting users, which is a decent activity rate early on.
Any particular uses taking off?
They highlighted tax payments through the app up 6 times QoQ, and bill payments up 57% QoQ. So businesses are starting to use it for core transactions.
So this digital focus is clear, but they also talk about their physical network, don't they?
They do, and that's the other side of their strategy. They call it a disproportionately large distribution network with unparalleled rural presence. It's this blend.
Digital front end, but still investing in branches.
Exactly. As of June 30th, they had 3,110 branches or banking outlets, up from about 3,000 a year ago, and over 3,000 ATMs as well.
And the total reach.
Their group network, including the BFIL points, spans over 7,200 locations, covering something like 164,000 villages.
So it's a dual strategy. High-tech digital combined with deep physical, especially rural reach.
Precisely. It's a powerful combination if they get it right, serving different customer segments and needs through both channels. A sort of phygital approach, as some call it.
Okay. Digital and network are strong points. But given those past discrepancies we talked about, what about leadership and governance now? Is it solid?
That's obviously critical, especially for rebuilding trust. And they seem keen to emphasize this. They talk about having an experienced board with diverse skills, banking, IT, agriculture, risk.
And the management team.
Seasoned professionals, extensive experience. The chairman, Mr. Sunil Mehta, made a specific point in the release. He said, the leadership transition is progressing well, and their final recommendations are with the regulator. That signals stability at the very top.
Trying to reassure stakeholders, presumably.
Absolutely. And they explicitly stated they've taken decisive action on legacy issues, strengthened governance, and enhanced controls. That's directly addressing those past problems.
So acknowledging it and claiming it's fixed.
And they're also working on something they call One IndusInd, trying to better integrate all their different business lines, create synergies, offer a more unified experience. That also speaks to internal strengthening.
Right. Beyond fixing internal issues, what about their broader responsibilities? ESG, environmental, social, governance.
Yes, they highlighted a few things there too. Seems to be an increasing focus area.
Like the water positivity.
Yeah, that was interesting. An independent assessment apparently confirmed that their community water projects recharged significantly more water in FY24 than the bank itself consumed. So they're claiming water positivity.
That's a notable environmental claim. Anything else on ESG?
They received an ESG rating of 61 out of 100 from NSE Sustainability Ratings. They flagged it as demonstrating strong performance, particularly on environmental and social metrics.
And on the governance side, related to lending.
They mentioned that in FY25, almost 1,800 larger corporate credit proposals went through an ESMS environmental and social management system risk evaluation, applying their board-approved policy.
So trying to embed ESG into their core lending decisions too.
Seems like it. And they also listed some recent awards: Infosys Finacle Award for Corporate Banking Innovation, a Digital Payments Award, and another one for the Indie app's user experience, reinforcing that innovation message alongside the responsibility angle.
Okay, so let's try and wrap this up. We've covered a lot of ground on IndusInd's Q1 FY26.
They certainly have.
We saw that crucial return to profitability, which is the headline news. Definitely good quarter on quarter.
But with that significant drop compared to last year still lingering.
Right. We saw really impressive growth in digital banking. The Indie apps look like they're gaining serious traction.
Coupled with that continued investment in their physical, especially rural network. that dual strategy.
Then we got into the challenges. The rising NPAs, particularly in segments like microloans and two-wheelers.
And crucially, how the bank is framing its response, acknowledging the past discrepancies, taking corrective action, strengthening governance, the whole cleaning house aspect.
Trying to build that trust back up.
Exactly. So for you listening, whether you're prepping for a meeting, just tracking the sector, or you're generally curious, hopefully seeing these pieces together.
The profit, the digital push, the network, the asset quality issues, the governance fixes.
Gives you a much richer, more nuanced picture than just reading a headline number. It's about seeing how a major bank like this tries to balance growth, innovation, and, importantly, managing its risks, especially when dealing with legacy issues and aiming for future stability.
Absolutely. It's a complex balancing act. So as we finish, maybe one final thought for you to chew on.
Okay.
Given IndusInd's very deliberate talk about decisive action on legacy issues and this ambitious digital 2.0 strategy
Yeah.
happening at the same time as these NPAs are ticking up,
Mm-hmm.
how might that play out? The simultaneous push for internal cleanup and external innovation.
Yeah.
How could that shape not just IndusInd's own path, but maybe the whole competitive scene for private banks in India over the next few quarters?
That's a great question to ponder. How does fixing the inside affect competing on the outside, especially when both are happening at once? Lots to watch there.